For joining us. The quarter two came into a wrap just a couple of weeks ago. So we like to really spend some time going over some of the major changes that we've seen in the market over the last 90 days. A couple of quick things I wanted to cover tonight with John. John's with us, so he's going to kind of finish us up for the second half. But four main areas I wanted to discuss. One was taxes, inflation, talk about interest rate changes, and then finish off strongly with a good old market update. So taxes, this is a really popular subject right now. Lots of headlines, lots of things it's almost a full-time job just keeping track of all the proposals and everything going on right now. So the first place I thought would make sense to really start with is a history of the taxes. Where are we in the grand scheme of things when it comes to our tax rate? Are we paying a lot of taxes or a little bit of taxes? Well, we have to go back over 100 years. We're in the third lowest tax rate we've seen in over 100 years. If you look at this chart, basically back in the Great Depression, we were in the low 20s. But coming down the Great Depression into World War II, we've seen a really big increase in taxes. A lot of popular sayings were made back then. Teddy Roosevelt made Trump or trust busting very famous. And so they were trying to tax the wealthy to pay for the war. So they did that for almost 40 years. If you look at this from 1940 to 1980, our average tax rate was well over 70%. In fact, from about 1940 to about 1960, our tax rates were over 90%. So again, right now, our highest tax bracket is 37%. So those brackets were 2 to 3 times higher than they were. So it wasn't until Reagan came in the 80s until we saw this big, massive decline in tax rates. So again, what we want to talk about tonight are some of the proposed tax changes that we've seen. And we have some suspicious that this won't be the only tax changes over the next 5, 10, 15 years. So this will be just kind of the first phase in taxes potentially going up. So jumping right into it, one of the first things I thought was worth mentioning were capital gains taxes. This is a really big one and something that's very highly debatable. But the good news is, I like to start off with, is this is not going to affect a lot of people tonight. This is not going to affect a lot of people because this is only going to affect people that are earning over $1 million. And by the way, these are proposed tax changes. These aren't anything that's been passed. These are the things that have been talked about so far. So if we go back to last night, the Senate has agreed on a $3.5 trillion basically spending infrastructure bill. We don't know what's in it. We don't know a lot of things about it, but these are the things that were talked about heading into those meetings. So for anyone earning over $1 million, they want to increase taxes on their capital gains. So they would pay 39.7% of any gains for those people making over $1 million. The reason why I think it's important to bring up is these numbers are easily changeable in the future. So right now it's for people making over $1 million. Well, next year it could be for people making over $3 million. Or the opposite might be true. It could be for people making over $150,000. So right now it's not affecting a lot of people across the country. However, one thing that could affect a lot of people are Social Security. So basically, most people rely on Social Security. Either you're already collecting it or you're nearing Social Security age. So just a background about how this is taxed is how they raise money for Social Security is through taxation. And they tax up to the first $142,000 of your taxes. So for an example, if you make $300,000, your entire $300,000 isn't taxable for Social Security, only up to $142,000. So why I bring this up is because we're trying to make a big change for that. Because if we start looking at actuary tables, our Social Security is scheduled to run dry by 2035. And I'm sure you've heard that stat before somewhere. If you haven't, let me clarify what that means. That just means that the Social Security reserves will run dry by 2035. As a country, the annual taxes that are collected for Social Security cover about 75% of the benefits. So 3/4. So what that does mean is that there's going to have to be cuts to our benefits unless they make some changes. So this proposal is not in the latest round. But again, if it's not today, if it's not this year, there's going to be changes to Social Security. So that's something that I thought was going to worth mentioning, because what they're trying to propose is anyone who's making over $400,000, they want to raise taxes on those earners. So they want to tax an additional 12% for any earnings over $400,000. So quite the tax jump for those earners. Moving on to step up in basis. One really want to kind of first explain what that step up in basis means. This really to show you an example is when you pass away, as of today, today's law is any gains that you had in your accounts, your beneficiaries don't pay taxes on it. They receive what's called a step up in basis. So for an example, let's say that you bought a stock for $100 and that stock grew to $1,000. That $900 in gains is not taxable to the beneficiary if you didn't sell it. So they receive what's called a step up in basis. They're trying to change that, but only for a very few people. So who they're trying to change that to initially is for anyone who has unrealized gains of over $1 million. So again, very, very few people, but I like to compare this as almost trying to put the toothpaste back in the tube. It's almost impossible to reverse once these laws become written, because now they can come back in and say, well, they can lower that threshold, they can increase that threshold, they can make it zero. Well, where's a real example of that happening? Estate taxes. Estate taxes have changed the threshold over 10 times the last 20 years alone. So a lot of these things can change quite a bit. So you may not be affected today, but you could be affected with future tax changes. The next thing we want to do is increase corporate taxes from 21% to 28%. Most likely, probably in the middle, somewhere around 25%. And the last thing is they want to have a 15% minimum tax on corporate earnings. So famous company called Amazon for the last several years have paid 0% taxes. So this is kind of the reasoning behind this law change, is no matter their deductions, no matter their strategies, by a minimum, they want to make sure that they're paying at least a 15% tax on their revenues. So that would be a big change. And so a lot of these changes are going to cause not only increased taxes for certain individuals, definitely corporations, but this is going to have a chain reaction down to basically the everyday person. And we'll kind of talk about what that could be here in just a second. So the biggest question is, what I want to answer is, who does this affect? Does this affect me? Does this affect my family, my parents? Who does this affect? So, well, this chart will show you exactly who this is going to affect. And so what this is going to break down is basically your percentile of earners. And this first column labeled conventional 2022, this basically shows you if there's a net positive or a net negative effect on your take-home net pay. And so really what you see here, only the top 5% of earners really are going to basically take home less money after these changes. If everything was in a vacuum, if the GDP stayed the same, if production stayed the same, if the stock market stayed the same, only the top 5% of people would have a negative impact. However, the lower income brackets, in particular the 0 to 20% group, they would actually receive 17% increase in their net after-tax benefits. So the lower income brackets are poised to benefit more, of course, than the highest earners. However, that's if things are happening in a vacuum. We know that you can't just change one thing without changing something else. So when you start increasing taxes, of course, that's going to affect salaries, wages, jobs, and really start having that chain reaction down the line. So when you start causing all the, by the way, they've done a lot of analysis and determined that after all these taxes changes are proposed, that GDP would decrease by about 0.4%. So because production slows, because the economy slightly slows, that's going to affect a lot of people's gross pay. And then they're going to tackle on the tax changes. So it's actually the top 40% of earners that could actually have a negative impact. So that's much higher than you might read. A lot of people say, well, only the top 1% are going to be affected, but no, because of the chain reaction, it's really going to affect a lot more people than you think. And that's just today. So again, as rules change, as tax laws and thresholds change, it could impact people more severely. as basically these things unwind. So I wanted to say, if you're in the top 5%, you're definitely going to be affected. If you're in the top 40%, you might see a slight change in your net take-home pay, all things being equal. So what does history say? What does history say when the government increases taxes? Well, the good news is we have a lot of data to back this up. Since 1950, we've had 13 tax increases. And so there's three main types of taxes. We have taxes on a personal level, on a corporate level, and capital gains. The last time we've seen all three of these things increase together was in 1993. And I've got a really good chart that I'll show you here in just a second. But the outcome, what we really started looking at is, well, what happens to the overall markets when the government increases taxes? So it's actually kind of surprising. The opposite has been true. Many people think, well, they're going to increase taxes, so I'm going to, not have as much money. Corporations won't have much money, so therefore the stock market must suffer. That's not true. And basically 12 of the 13 years, we've seen above average, not just positive gains, above average returns in 12 of those 13 years of tax changes. The other thing too, that's pretty counterintuitive, are bonds. You'd think the market would struggle. You think bonds would do better. Well, bonds have already struggled over the last 10 years. And now we see another headwind for bonds, because typically when, again, opposite being true, is people want to get defensive in these type of periods. So how do you get defensive? Historically, you go buy bonds. Well, really, basically bonds have struggled during times where taxes have increased. So it's going to be really very, very critical to actively manage your bond portfolio. That's what we're doing here. So it's going to be really important to continue doing that. We don't want to be sitting passively just in the bond space. So I'm really targeting bonds in this conversation. We don't want to be very passive when it comes to our bond holdings, because bonds are one of the most interest rate sensitive investment that you could own. And so when we see tax changes, interest rate changes, inflation moving all around the bond space, we're going to manage these things very, very carefully. So, and then lastly, here's a chart of basically the last 13 years they've changed or have increased taxes. This lower portion of the screen will identify whether it was a tax rate increase for personal taxes, corporate taxes, or capital gains taxes. One big thing that you might see is the easiest and the most often thing they change are capital gains. Almost basically 10 of the 13 years there was a change that had to deal with capital gains. But looking on the right-hand side of the screen, you'll see 1993. This is the year I was referring to when they increased all three together. So if you look at the red bars will indicate the overall S&P 500 percentage change. And if you notice, you see 22%, 16%, 30%. I mean, as far as back to, or as early as 2013. So we've seen some large returns when the market has experienced tax increases. So again, that's why it's really important to remove emotion away from investments, because many people, our human brains, we're hardwired to think we're going to pay more money, the market's going to struggle. Not saying that this trend is going to continue, because here's one thing I wanted to point out. Look at the couple of years the market basically performed below average, 1969 and really 1993. And you have to be careful about, because what happens is, well, what would cause the market to go up in these years? Well, usually what happens is if they're increasing taxes, they're dramatically increasing government spending somewhere. So we have to be really careful and very critical about where's the government spending that money. So if we look at the areas where they spent the money on social welfare and social programs like they did in 1993 and 1969, between 68 and 1969, they spent had some of the biggest increases ever in the history of the country relatively in welfare spending. And that's when we see the biggest decline and a lower return for the same reason in 1993. So again, we have to really analyze, really see of all these proposed tax changes, of all these places that are trying to increase taxes, where are they going to spend the money? And so that's going to really answer a lot of our questions of how do we maintain your investments? How do we basically invest going forward? So I'm here to say, this won't be the first time taxes will change. So there's a lot of things that we can do proactively. It's going to be more important for usually just, the top 5, 10, 15% of earners had to be careful about managing their taxes effectively. But because of these changes, now a lot more people across the board are going to have to spend extra time, be extra careful when it comes to managing their investments, their earnings, their income, to make sure that we're not paying Uncle Sam a pretty penny. So we are going to record this seminar. I know we had some struggles tonight, so I'm also going to send this out here in a couple of days. But to finish things off, I'm going to have John Lawton come up to talk about inflation and taxes, and then I'll come back up at the end, or both of us will be here to answer any questions that you might have. And also feel free to use that question box too if you're afraid you might forget your question. Thanks, guys, and talk to you guys soon.
All right, so thanks everybody. Let's keep moving on. Moving on to inflation, and inflation is just basically the cost of goods going up. And I thought it was pretty interesting. I found this chart from June 24th that just showed you a couple of the things that were your top line items that were increasing in price over the time period. And the number one headline has been lumber. In fact, at its very height, lumber was up about 168% year over year. As of today, it's crashed back down to where it's even for the year. So no gain there. Natural gas is one that we're watching, as is West Texas Intermediate crude, gasoline. You can go all the way down. Another interesting one are these down here below, platinum and gold. Platinum up 28%. Gold is pretty even for the time period. But when we look at lumber for the whole year, you can see, and most of these prices and most of inflation really kind of peaked here in early May. So whenever you're looking at that May number, that's when most of the scare for inflation was at its highest peak. And really, the question is the question that you've seen if you've been reading in the news: is it transitory or is it inflation? And transitory basically means, is this a temporary thing that's happening, or is it inflation, which means it's going to stick around and be a big problem? And I'll read you a quote. I thought this was a good quote from somebody in the George W. Bush administration that said a lot of people called it inflation when it was lurches and spasms of a disrupted supply chain returning to normal. And so I think that's what we've seen a lot of. Everybody's been locked up and not been able to spend. In fact, Bespoke had a report. One of the research companies that we buy their research is Bespoke, and they had a note out the other day that said in the next 6 months, you will see 4 years worth of travel expenses expended. So we're going to spend 4 years worth of travel expenses over the next 6 months. Folks, when you were going from a shutdown economy and opening it up to that extent, there's going to be lurches and spasms. And I think that's really what we're seeing. Some of the inflation, I'm sure, will be here to stay. And we'll look at that. Here is your inflation number since 1980. So in the 1980s, you're up here in the 15% mark. Since 2008, we've really been running a really low inflationary number. The FOMC met yesterday. Their expectation for inflation was 5%. It came in at 5.4, so it came in above expectation. This is a number is as high as it was in 2008. So we haven't seen inflation that high in a long time. So here you go. Estimate was 5%. June was 5.4. Core inflation was 4.5%. One of the things I thought was really interesting about this number, and you can read it here, used car prices made up a third of that core inflation. So when you look at that 5.4, a third of that is your used car prices, making up that core inflationary number. Core inflation is different than CPI. Consumer price index, this is kind of going in the weeds, but consumer price index includes food and energy. Core inflation excludes food and energy. So those are two different numbers that people use. So let's dig into automobiles and used car sales here a little bit. Manheim Auction is one of the biggest auctions in the United States. And as you can see from this chart, as a CPI number for margins for used car sales is going up, actually Manheim auto prices month over month are actually starting to come down. This number here will be, or this blue line is a leading indicator, so we should see this number come down. In fact, I don't know how to scroll with this, Stuart. How do I scroll? Pull down here. So if I go here, soaring core inflation is mostly a COVID reopening story. So that number that we see, that's a big, scary 5.4%. Again, I would relate that back to lurches and spasms of a reopening economy. Again, I think some of it's here to say. The one that we're watching right now is really oil, that gasoline, West Texas Intermediate crude, any of the heating oils, those are still very high. They're average about 75% up year to date. Interesting thing today, OPEC Plus met today and is coming up with a deal to increase supply, which should help that number come down there as well. So a lot of these things, again, it's a reopening story. A lot of this stuff will settle out. And here's a note from Goldman: prices in supply constrained categories, so where supply was constrained, are likely to remain firm for at least a couple more months, but will eventually become one-off disinflationary drag. We expect core inflation to fall to 3% by year-end 2021 and 2% by 2022. So a lot of the banks that we use, again, Goldman's one of the primary research facilities that we use, is really saying this is transitory, this is temporary as we're reopening, and we really see a lot of this coming back down again. As far as, looks like part of my presentation isn't here, but that's okay. I can do it from memory. Just giving you a quick market update. The last 8 months, the market has basically gone vertical. I mean, we've over the last 8 months, the market has just continued to go up. This last month has been interesting in that the breadth, so the width of the economy, or the those things making new highs, has been limited. So we haven't seen where our you're changing. Okay. Let's see if we can fix this here. Keep scrolling down. Okay, here's interest rate. There we go. There's interest rates. Okay, we'll keep it going from here. And I'll try to be quick about this. I know we've taken up a lot of your time this evening. Interest rates, Federal Reserve Chairman Powell spoke today. No interest rates hikes through 2022. They're projecting interest rate hikes in 2023. The interesting thing about the relationship between interest rates and inflation, when we think that inflation is going up, you should see the 10-year Treasury go up as well. When inflation isn't much of a concern anymore, you'll start to see that 10-year Treasury go down. Here's a chart of the 10-year Treasury. As you can see, remember we talked about it earlier, those lumber prices, that oil, gold, well, not gold, but silver, platinum, rice, corn, all peaked there in May. That's where you saw the peaking of the 10-year Treasury. And since then, it's really started to come down. It kind of came back up again. As of today, is back down to 1.39 on your 10-year Treasury, which really drives a lot of interest rates for mortgages and everything else. But I thought that was interesting. Yeah, getting to our market update, let's go to valuations. Valuations currently remain stretched. What that means is we're seeing valuations in companies go beyond the expectation for what their revenues really are. So if you're looking at their price to income ratios, they're stretched right now. They're higher than they really should be. We believe U.S. equities can sustain that elevated level. They'll stay there as economic recovery continues to bring up that the revenue from each one of those companies. Currently, economic recovery, easing policy, and improved corporate profitability are what are keeping those equity prices high and those valuations stretched. Internationally, they're a little bit behind us, where the U.S. has really reopened faster. More vaccine helps the risk of that pandemic risk abate, allows us to recover faster. Internationally, they're a little bit behind us, so we should see them start to pick up their growth there as well. If we look at the S&P 500 or U.S. large companies, your FANG stocks, other than Netflix, are really the ones that are keeping up the market, where A lot of the other areas of the market haven't been able to keep up with those primary core mega caps. So looking through July, I would say we probably have some chop through July and August, but we still see positive, we still see the market being positive through the end of the year from where we are today through the end of the year. Again, if you look at IFAS Insight, they're saying 9% from here. That seems like crystal ball stuff, but they've been able to call it pretty well. Growth, the pace of the US GDP likely peaked in second quarter of 2021. Here again, that's that May number that I think we really saw the pace, not the GDP growth, but the pace or that acceleration really peaked in May. Not to say that we're not still growing, but the speed of it really peaked there in May. Non-US economic growth will accelerate and hit its peak in third quarter 2021 as Europe, Japan, and emerging markets ex-China all accelerate through the peak growth rates. That's going to give us rotation. And just like Stuart said, that's one of the biggest things that we watch is areas of the market where we can be opportunistic. And we'll be opportunistic where we can, depending on the rotation and where the trades are that we're doing. So cyclical stocks, FANG stocks, basically trying to be opportunistic in our trades to make sure that we're in the areas of the market that should do well. Volatility, investors' long positioning and extended allocations could pose some risk in down markets, but really liquidity and market breadth could offset that impact. Again, we just haven't seen much volatility in the last, really since March of 2020. We had a little bit in October, and that's why I say from October, right around October 24th, was the last time we had a down month. Since then, the last 8 months have been all positive. We really haven't seen a lot of volatility. In fact, every day it seems like we've been notching a new all-time high. And so having some volatility here in summer months, there's usually we should see some volatility in the summer months. We would look at that and encourage buying the dip rather than de-risking the portfolio. I wouldn't see that again if we were to go back to our research partners and look at where their year-end targets are. All of them are above where we are today, so we can see continued growth through the end of the year, but maybe a little bit of volatility through the end of the summer. So that's your interest rate talk, your inflation talk, your tax talk, and the market update. At this point, I'm going to have Stuart come back over here. We'll open up for questions. I know that we have the question panel open. We want to make sure we take time to answer any questions anybody has.
And we are going to reset the hands. I see a couple of hands. Well, just one. I'm going to reset the hand. So if you have a question, just go ahead and hit the raise your hand button on this, and I'll unmute you. Nobody? Anybody want to be the first? Well, very good. Let me see oh, there we go. We got a question. All right, Tammy, can you hear us?
You got muted. Oh, you're unmuted.
Here, maybe I now. Can you hear me?
Yes, ma'am.
Okay. I was going to ask, how do you see the chip shortage affecting the markets and affecting various industries?
Oh, okay.
Yeah, that's a really great question. In fact, there is Goldman's got a whole piece specifically talking about that. From your chip manufacturers and that whole manufacturing sector to cars and computers and where that whole line plays out. I thought it was interesting. Apple talking about, CEO of Apple talking about they basically have that taken care of. But there are, there's a piece from specifically from Goldman, Tammy, that we can send out to you that talks to this point specifically. I know that it came out about 30 days ago. It's been about 30 days since I read it. As far as any notes, it hasn't been a top line note in anything that I've read here recently, really in the last 30 days.
Okay,
Not to say that that's not a concern. It has been. I'm not sure where we are as of today to that specifically, but I can educate myself over tonight and get you a really good answer tomorrow.
okay. I'd appreciate it. Thank you.
Yeah. One thing that we do notice though, and kind of to John's point, is that it's getting closer back to normal. Supply chains are opening up, logistically it's becoming a little bit easier to solve. So you start looking at the manufacturing production time, it's beginning to get much quicker as of
Okay,
90 days, 120 days. So if you have a used car, what I'm saying is go sell it now, not 3 months from now. Well, we see this reverting back to the mean, maybe not overnight, but probably, definitely in the next 6 months.
I have several friends who have recently traded in used cars and bought new cars, and they get such a good deal on the trade-in. And I think that dealerships are making more money on the trade-ins than there are the new cars. So it's like they want their hands on those trade-ins.
Yeah, and you might be right. I've seen some used cars now going, for more than new cars. So it is a crazy
Yeah,
time that we've always been taught that cars are declining assets. So now
that's right.
opposite is true. It's kind of ironic right now.
That 93 Corolla is your inflationary trade.
Who would have thought?
Who'd have thought? Very good. Well, good question. Anything else? Perfect. All right. Well, guys, I really appreciate it, and I want to apologize once again. I'm so sorry that I talked to myself for 17 minutes. I have a big old, I don't know, 35-inch, 40-inch monitor in my office that I throw my laptop to, and my laptop was closed. So it was unmuted. However, my laptop was a microphone. So I am so sorry that I wasted your 15 minutes on a Wednesday night, but I'll get this recorded. I'll get this through compliance, and I'll get this thing out to you guys shortly. And for all my clients, I'll talk to you later this week, answer any questions, and kind of follow up on an individual basis. But thanks again, and I'll talk to you guys soon.
Thanks, guys.
I can't believe that.